Y'all, chill out. It's gonna be fine. We're gonna be just fine. The stock market is not crashed and you don't need to sell all your stocks. You can put your paper hands back in your pocket. We're gonna diamond hands this out. We'll make it through all right. I'm gonna help you, trust me. I'm gonna help you power through the chaos and get back to your moment of financial zen. If this is your first time here, welcome. If not, welcome back to my channel. This is Zenvest. I'm Alexander Victor, and I'm going to help you with your personal finance endeavors by helping you tame your emotions and to help you remove them from finance. Leave them behind, that urge to buy or sell for the fear of missing out and all that. I'll walk you through the psychology of finance and to help you get your portfolio back on track. All I ask is that you invest in that like button. What's going on with the stock market? Honestly, nothing. This is perfectly normal, and you should chill out. Really, we're not going through another crash. Ride the wave. Buy the dip. Google Trends for the vaccine is at an all-time high, featured on the front page of Google Trends. This could be the financial institutions moving their money from their investments to lower, slower-growing, dividend-producing investments. It is standard practice to rebalance their portfolios. These fund managers need to keep these portfolios slow and steady growth, which appears to be safe and keeps them out of trouble. Think about it. If you were a fund manager and the funds that you manage lost thousands in a short period of time, regardless of the fact that 70% of the time the portfolio will recover in 4 months, then go to higher highs, people will get scared and request for the sale of their assets. If the firm loses their account or you get enough complaints, they could fire you based off of that, or you could be sued. And good luck getting a job after that. Nobody wants you to lose their money. Of course, if you're a fund manager and you are incentivized to pick less volatile, more predictable investments, who cares if your clients only make 6.5% return in a year when you could easily make 50% return? As long as your company has the accounts, that's all that matters. The investors have about 40 years to invest. Through multiple economic downturns, a portfolio can recover many times, but an emotional investor may have a low tolerance for volatility. In finance, we use this word risk frivolously. Risk describes the market value of a portfolio at any given time. The word risk, given to someone who is not too familiar with finance, makes it sound like you're going to lose your entire investment down to zero in a short period of time. But to be honest, the probability of that happening is extremely small. The risk really applies more to the fund manager than it does for the individual investor. Using the word risk enables the manager to sell lower returning investments, allowing the manager to have more control.
Give me one shot here on a blue chip stock like Kodak. And believe me, Kevin, the only problem you're gonna have is that you didn't buy more. Sound fair enough?
Shit, my wife might divorce me, but yeah, let's do it.
Stick with growth stocks. I'm not a financial advisor, nor will I work for a financial institution. If I did, I probably wouldn't be able to share this information with you, and because of that, I don't want to work for a financial institution. Unless they allow me to continue bringing up millennials and Gen Z. Unless it was ARK Invest. I literally would turn down offers with literally no pay because I know I'm helping people here. In this day and age, we don't need to rely on managers and financial advisors to invest for us. We have all the resources we need to determine our own risk tolerance and make a return many times higher. If you look at the companies that are considered recovery stocks, most are low to no growth and have a low to mid dividend yield. To a financial advisor, these are safe bets. To a millennials and Gen Z, these are a waste of time. You do not need dividend stocks. You do not need low growth in your portfolio. You are not retiring for decades. And if you expect to retire early within a decade, I would recommend you to invest in high growth stocks for the first 9 years. And in your 10th year, shift over to dividend stocks. Dividend stocks typically do not grow very fast, and so you don't need to rush into them over time. You could buy a dividend stock a decade from now with much more capital and get a higher return than somebody investing in those same dividend stocks over 10 years. Check this out.
SPHD compared against ARK Invest flagship ETF, okay? So I just wanted to show you guys these two funds compared against each other, ARK Invest Fund versus the SPHD High Dividend Yield Low Volatility Fund. Okay, if I was going to invest in a dividend fund, this is the one I would choose. But I just wanted to show you guys the difference between the two, just to show you what we're working with. Okay, so if you were to buy SPHD right now, the cost for SPHD would be $39.27. Okay, $5,000 you'd be able to buy 127 shares. Okay. Year-over-year return for SPHD is 7.4%. That's to include the dip over the COVID dip. It's going to compound for 5 years, so every year it's going to compound 7.4%. And then we're going to have contributions of $5,000 every year. Okay, as a dividend yield, again, this is a high dividend yield index fund. A dividend yield 1.8.
With $1.08 per share.
Okay, and you multiply that by how many shares you have. Okay, and what you're going to get is $1,126. Then you add that on top of what you would get if you had this much money invested over 5 years. Add that together, and you're going to get $37,000, $37,255.59 at the end of 5 years. Okay, so let's take the same $5,000, and instead of buying SPHD, we're going to buy ARK Invest. Now, the ARK Invest ETF right now costs $130 per share, and that's going to get you 38 shares. Okay, so we started with $5,000, and year over year, ARK Invest has a return of 54.3%. That's going to compound for 5 years, and every year we're going to add $5,000 to our funds. Now, ARK Invest did have a dividend for the end of last year, but I'm not going to count that in, just for the sake of, so you see what I'm talking about. Okay, with the 54% return over 5 years, ARK Invest, you're going to get
$15,061.73. Okay, then we want to go ahead and imagine at the end of 5 years, we're going to take this out, and we're going to go ahead and buy SPHD. Okay, we're going to take out $115,000. We're going to buy SPHD. We're going to get our 127 shares, and that's going to give us,
at the end of 5 years, we're going to take out our $115,000. We're going to buy SPHD at about $39 per share. Now, granted, it would be a little higher, but, just for the sake of, calculation. I mean, we wouldn't even see more than, I would say $50 max here. You would take your $115,000, buy SPHD at $39, or buy SPHD at $39, and that would give you about 2,930 shares. Okay, and 2,930 shares is going to get you $5,274 in dividend income. Okay, now you have these two purchases that you made, same amount of time, same amount of money put into it. At the end of 5 years, one is the dividend yield of $1,126, and if you went with ARK Invest, you take the same $5,000, and at the end of 5 years, you just took it out and you bought SPHD. You're going to come up with the $5,000 per month. No, sorry, $5,000 per year dividend. Okay, so again,
same money, same time, different result in the end. Okay, you leave the money in SPHD for 5 years, you come out with $1,126 of dividend income versus $5,274 of dividend income.
ARK Invest is 3 times better. You're going to get 3 times more return if you just do it this way than staying SPHD the whole time. And if you worry about taxes, well, when you get dividend income, you're going to get taxed as regular income the whole time. Okay, but if it's in growth, you're not going to get taxed on the dividend income because there are no dividends. You're not going to get taxed on capital gains if you don't sell it. Okay, and then if you hold this for 5 years, okay, and let's say your income is less than 40 grand a year, or 80 grand if you're married, 40 grand a year single, 80 grand if you're married, well, then that means that you're not going to pay taxes as long as you hold this for more than a year. Okay, worst case scenario, you would just pay on the last year of taxes, which would be only 1/5 of the amount, and whatever you got from capital gains, that's over your cap, and still it would be 15%, so significantly less than you would pay taxes in here.
You guys, I wanted to show you my calculator in action and how I determine what and when I'm going to buy. Okay, so right now we're looking at Ethereum. Pretty much, if you bought anything on the market right now, you're getting a good deal for it. So I say, if you're looking at it for a while, go ahead and go up for it, as long as you're not buying off of FOMO. The market is on sale, and just like if you were in a store and you found some shoes that you wanted for a while, and finally they popped up on sale, and you finally want to get those shoes, go get those shoes.
Now's the fucking time!
Okay, so I just wanted to show you. I'm going to do a price prediction for Ethereum, and I just wanted to show you guys that, you know, this green line kind of indicates the average of the lows. Okay, so when this blue line comes and it touches this green line, it tells me that it has reached the average of the lows, and this is a great time to buy. Okay, I am in buy mode for Ethereum right now. Okay. So Ethereum, I'm buying in right here. We're right where we need to be for the buy mode. Okay, and I just wanted to show you again. For Ethereum, we're looking good, and I was kind of holding off on NIO for a bit too. NIO, same thing. Blue touching the green, we're in buy mode. Okay, so NIO, if you've been waiting to you feel like you missed on that NIO train, now's the time to catch the train. I'm hopping on board Ethereum, NIO as well. Okay, and so I got one cryptocurrency for you guys. I got one stock for you guys, and then I'll close it out with one ETF, ARK Invest. Again, same thing. Blue touching the green. It's go time, baby. All right, this is where we want to be when we're looking at buying things, okay, or buying stocks or buying into them. When you're looking for, you got to find out when to buy, when to hold, okay. And my method of growth stocks.
I'm not fucking leaving!
Okay, so this is how I use my indicator on when to buy. Okay, finally, let's get into the price predictions. I know this is what you guys came here for. So first we have NIO, and how this works is I'll put a principal down, and then we're going to project a year out from now. So for NIO, $1,000 down today, we're going to predict out NIO. I'm looking at 513% return. $6,125 by next year in March. Next, we're looking at ARKK, $1,000 down today. We'll get you a return 193% and turn your $1,000 into $2,934. And finally, for Ethereum, 343% for a return of $6,453 on your $1,000 investment by March next year. That's all I got for today, guys. Thanks very much for making it all the way through. Don't forget to smash the like button, subscribe for more videos in the future, and go ahead and join our Zenvest Discord if you want to ask me any questions or find out how I got these numbers. I'm always available for that. Okay? Well, until next time, guys, and don't forget, invest in yourself in the future.